So we're the salty investors, and how come we are the salty investors, Tim? What's the reason?
Well,
Why are we salty?
A few things have gone wrong, and over time, and haven't invested in a few things that we probably should have. Mainly things out of our control, like central banking.
Are you saying that you didn't buy into the Yeah, Are you saying you didn't buy into the decades-long free money, buy whatever's in sight, and everything goes up? You weren't part of that. Is that why you're a bit salty?
30-year mortgage, locked in. I'm hoping I've got a job for 30 years. Stable income for 30 years. Sort of didn't seem like the best investment in the world.
Well, the good news for you is that if you don't have a mortgage, and I think over 90% of the people in Australia who do have a variable rate mortgage, and they're going to get, they are getting in the process of getting a few shocks. So today is September the 15th, and last Tuesday, the RBA decided to lift the overnight cash rate by another 50 basis points. They're now at 2.35, and that's off a low of 0.35. So they've gone 200 basis points in a pretty short period of time. That's 4 months. They started in May, just before the election. Remember, they said we're not going to lift rates until we see wages growth, and then they lifted rates anyway. And that's on the back of we're not going to lift rates until 2024. So do we actually believe anything the RBA says at this point? And why has Philip Lowe still got a job?
Well, we're sort of lockstep with the Fed, We're exactly the same level as the Fed now. And I know they've gone a bit quicker and they've had an extra hike, but really, do we really need the RBA at all? I don't know, if we're doing exactly the same thing as the Fed, I don't know what the RBA is really adding to the equation here.
I mean, economic forecasts in general you should just ignore them generally. The RBA's proved conclusively that they have no idea what the economy is going to do in the short, medium or long term. What is the point of them? I suppose the standard answer these days is that it's the lender of last resort, although you would say that the Fed has a remit of full employment and low inflation, which is, I think, ridiculous. They shouldn't even be meddling with that at all. But the consequences here, what are the consequences for Aussies? As we said, we're now at 2.35%. So we've seen the biggest increase in interest rates, not in a basis points, but more than a doubling in such a short period of time. And the markets still think there's a bit to go, and the RBA indicated that as well in their statement. Not going to read the statement. If you've ever read an RBA statement, it's boring as batshit. Don't read them. It's deliberately vague so as not to spook markets, which should tell you something about the RBA's outsized influence on markets. But right now, if you look at this chart we got up there, this is the RBA rate tracker, and basically, as of yesterday, it's a 67% chance. That's what the market thinks, that the RBA is going to go another 50 basis points in October, which is fun for everybody. That's some more mortgage stress. And I think the market now is saying, what's that?
The CME is saying the Fed is 24% chance of doing 100 basis points at their next meeting. That's a pretty. They go 100. They're going
to take them up to close to 4.
3.5. Yes.
Our markets. This chart here is showing that our markets reckon that we're going to get to about 3.6, and then there's going to be rate cuts. There's going to be at least one rate cut by the end, the end of 23. So, who knows? I don't pay any attention to these things because if you look at these, they change all the time. But suffice to say, although we can't believe anything the Reserve Bank says, probably going a little higher in the shorter term. Again, what does that mean for your average Joe out there? I think not a lot of good news in it, really, if you think about it. Well, let me find something here. So this is a chart. This is courtesy of Leith Van Onselen, posts over at Macro Business, and he's showing that if you look at mortgage payments as a proportion of income, from a year ago, they've gone from 34% to 44%. That's a pretty big jump. And they were below 30% there early in the pandemic. They've been much higher, as in 08. But and you got to remember that as of now, mortgage holders have only felt the first two rate rises, May and June, because there's a lag. The banks have got to give a 32-day notice period that they're putting your mortgage up for a start. So these mortgage, just because the Reserve Bank hikes rates doesn't mean you find out next week that you've got a higher payment. These things lag, and they say that usually it takes take up to a year for the full effects of these things to be felt. So I think there's a lot of fun in store for people with variable rate mortgages. That's obviously tongue in cheek. And it's only going to get worse from here. Just another little piece of data there. I don't know if you can see that. It's not exactly huge. I'll blow it up a bit.
Yeah.
So you can see there on a $500,000 mortgage.
30%. Back in the day, it used to be a 30%. You service your mortgage at 30%. What's happened to that? That number's out the window, and we can go to 45, 55. What do you want to go to? 70%?
Why not?
Where does it end you?
Yeah, I mean, just every spare dollar goes to your mortgage and you don't eat. Everybody goes on a fasting diet for like 12 months, something like that. Mortgage sizes, so the standard variable's gone from 3.45 to 5.2 in the space of 4 months. So that's added 23% increase to your mortgage. And that's, if you've got a $500,000 mortgage, that's about $500 a month more. You've got $1 million mortgage, so people in capital cities, that's not unusual these days. There's an extra $1,000 a month. And remember, again, this is only 2 rate rises and we've had 4 and we're going to have more. So lots of fun in store there for Aussies with variable rate mortgages.
So what are they going to cut back on? Seriously, like food is probably they have to downgrade some of the food
Netflix,
choices.
Yeah. Maybe the kids' tutor, if they've got one, special after-school lessons or something like that. No more getting someone to come and wash your dog for you.
Mm-hmm. I think the second-hand car market might change, like that second car that they've got sitting around. Might not be classed as an asset anymore. That's going up in value at a considerable rate. A whole heap of them might actually end up on the market again. If you need some extra cash.
Yeah, and then we'll have the complete opposite effect.
Of COVID. So that might be a huge shake-up for people who purchased all that expensive, Land Rovers and cruisers and everything, and then, they'll be sitting on an asset that they think is worth 80 grand. Now it's only worth 40 or something because there's a flood of them on the market, and they need the cash.
Absolutely. So, well, you can start selling stuff. So have a look out on eBay and all those places. Now, I think this is, and I think this. It's bad enough that you've got rate rises, right? But what else have you got coming down the pike? So next month, people will get their September end quarter electricity bill, and we know what that's doing. Electricity prices are going up. Palaszczuk's already throwing I think up to $175 per household for electricity bills, depending on your circumstances. So they know it's coming. Governments know it's coming. I mean, the Labor government's basically sort of shrugged their shoulders and said, what can we do about it? Now, they do have levers they can pull. They've got AMO. They can reserve gas and stop sending it all overseas. Are they going to do it? Who knows? They've sort of hinted, But, to say that they can't do anything is wrong. Should they do something? I don't know.
Like a hit the GST.
And the other thing on top of that,
they don't have to be so greedy.
Yeah, exactly.
Do some GST relief if they.
Well, yeah. I mean, that's the other thing, isn't it? Petrol prices that that subsidy that Morrison brought in before the election.
30th
That goes
September.
away at the end of this month. Yeah. So you've got that. And then you've also got, we've just had this Jobs and Wages Summit, and they want to bring in a record number of immigrants, which is, that's what a great idea. What a great idea to bring them in. At the same time, you've got rising inflation. You'll have a cutback in discretionary spending. Budgets get tighter.
Yep.
Inevitably, I think unemployment's going to go up, and you're going to funnel in another 200,000 people. I think that was the number, 200,000 plus in flood the labour market. Geez, that's good. I mean, at the same time, real wages are back to 2014 levels, because wages haven't been growing in line with inflation. And all you're going to do is push wages down even further. This chart here, again, from Macro Business, shows the first one is real GDP. So the red is obviously where COVID started, right? So real GDP obviously took a real dive, and it's sort of getting back to trend. Real GDP per capita, which is actually what matters more for individuals and households, their standard of living, has actually been going up above trend for the last, 3 quarters. Why? Because we're doing more with less, because we haven't had immigration. We haven't had much immigration, pretty much stopped. So this, you would think that this might be a hint, that actually, immigration's good up to a point, certain number is good, but, just flooding the labour market is going to wipe away all those GDP per capita gains, which is...
only time to work and got an increase is the last year or two, started to have some pricing power with their wages, and then all of a sudden, the rug pull's going to start happening on them again. No.
We can't have that. Yeah, we can't have the workers. The share of income going to workers is it's way down, and share of profits to companies is way up. So, there are distortions here and there. Of course, commodity prices have distorted outsized profits of mining companies. But this is a bipartisan. Both the Liberal and the Labor. When they came out and said this with the Labor Party, the only thing that Dutton could say was, well, we want to make sure that they really are skilled workers. No comment on the number, like what it's going to do to people who live here, the kind of crush loading on capital cities that happens when they do this sort of stuff. No, don't worry about the infrastructure. We don't have enough hospitals, roads, houses. Who cares? Jerry Harvey can sell a few more couches, and that's what matters. So,
yep. See, Jerry gets up and complains, as soon as immigration goes down a little bit, he's up there, first one up there saying, we need to increase the quotas more, and so he can sell more of his Chinese junk. So,
he doesn't live in Western Sydney or, doesn't bother him.
Doesn't have to stays at home, doesn't have to catch the public transport or sit on the roads and the traffic all day trying to, or get in public hospital, just to get an emergency. He doesn't have to do any of that, so.
Yeah.
All good for him.
So, we are, you and I, we're investors, or we think we are, we pretend to be. And this all, I don't know, you look at the stock market, it's had a bad first half year, not as bad as the US, but is this all priced in? I don't know. Is it all priced in? More rate rises, mortgage stress, electricity prices going up, your petrol prices are going to go back up, and crush loading of immigration next year. This just doesn't sound a recipe for a good economic outcome. It's got to have a detrimental impact on profitability of companies sooner or later. They can't keep consistently just passing on price rises, although maybe the supermarkets can, but not everybody can do that. Yeah,
the earnings part of the multiple is definitely going to take a hit here somewhere. You can't just keep having increased earnings. Like that's increasing interest rates. So it doesn't make any sense.
That's one of
the capital somehow. So.
Yeah, that's one of the mistakes that some people make. I've seen it before, previous cycles, where so you get share prices come down, 20, 30, 40, 50%. You go, oh, the multiple's been compressed. And say, but there's another side to that. That's the earnings. So don't get excited because you see something fall from a 30 PE to a 15. because the earnings, if the earnings halve, then you're back up to 30 anyway, and you don't have any growth to justify it. So, yeah.
But I'm more worried about the tightening. Like no one's really the bonds. You know, if they're gonna continue that. Like the interest rates, yeah, everyone can see that. That's plain. You know, you can see that. But how much are they going to roll off the tightening? No one mentions that. So when you add that with the interest rate hikes.
Yeah, when the Fed starts their tightening, when is it? Has it started? I mean, it's this...
they have started, yes. But that's just little bits of rolling off, you know.
But they're ramping it up, aren't they?
So who knows how severe that's going to be? And you can't really feel that until, you know, it hits the market. And, why is no one buying bonds? Ray Dalio just did a really good article about it. And he reckons it's, you know, twice the effect of the interest rates. So, you know, what do you think the interest rates are going to do? So he thinks, you know, we're going to get 4% inflation, you know, and then the Fed's got to fight that to some degree. Then you add on the bonds. Who's going to buy all this crap? You know, like someone's got to buy all this paper, you know. So I can't see the Chinese, you know, Russians aren't going to be buying it, I'm pretty sure. So the Japanese
have got their own problems at the moment.
So who's going to be buying all this paper, you know, that's supposed to be rolling off? When you add that in interest rate rises, I'm not... It's a bit hard to factor in, you know, what's going to happen to the markets. So, what do you think?
Well, just less liquidity. I mean, you've habituated people for the last 10 or more years to easy money, and what do you do in an opposite environment? And I'm sort of in the camp here where I can listen to a bear case one day and a bull case the next day and change my mind. You know, it's unclear to me how this all plays out. And I remember during the financial crisis that one of the things you learn is that the bear case always sounds more rational because there's lots of things to worry about. We've already talked about it, you know, inflation, rising mortgage repayments, mortgage stress, all this sort of stuff. And you can get carried away thinking, you know, end of the world scenario, you know. And, you know, what hasn't happened yet, Harry Dent hasn't popped up with a new book. You know, Harry Dent, he just turns up every 5 years and says there's an apocalypse, and then he goes away and people forget for some reason. You know, haven't seen that yet. But and we haven't seen full on capitulation in the markets. You might, I mean, the first half of the year in the United States was horrendous, but and again, do you need full on capitulation? You know, like even Jeremy Grantham in his he penned. I found it in Livewire Markets. What's that? About 2 weeks ago, and he's saying, you know, the super bubble hasn't fully deflated, but he said, you know, he might be wrong, but he, you know, and Grantham, and a lot of people roll their eyes when they hear Grantham because Grantham is, you know, they at GMO they run this sort of 7-year portfolio of prospective returns, and US equities have always had. They've always forecasting low returns for US equities, and that hasn't turned out anyway in the last decade. But you know, sooner or later, he's going to be right. But a lot of people collectively roll their eyes when they hear Grantham say stuff like this. But you know, he will be right.
But I looked at how he defends it. He's got big tech. He's got I think he's got Microsoft. You know, that's his defensive play, and some healthcare provider. I'm like, wow, like. I don't know how well they're going to do in a downturn anyway, but I don't know.
Well, I think the thing about big tech,
PEs there.
Absolutely. But I think this time around, if you compare it to 2000, a lot more of the big tech companies actually are profitable. You know what I mean? Amazon didn't make money back then. Amazon actually did a cap raise. The only cap raise they've done since they came public, I think. Back then.
Oh, don't talk about that. That's a lot of these large talking about Amazon. How I missed that.
Well, you didn't buy it at $6. Yeah,
no,
you didn't buy it at $6.
How salty you got to be there? You know, thinking, just, you know, holding back capital and reinvesting it, and just not letting it, you know, end up on the balance sheet. You know, all the value investors just let that one fly, couldn't go near it.
But you know what? Like, if you'd have bought it at $6, you would have sold it at 12 and thought you're a genius. Now it's, what is it now? $3,000. I don't know. Have they had splits? Maybe they have. I don't know.
Yeah, that's split adjust. Yeah, I know. But I know, but still, it's like a crazy return. Nick Sleep has held it. There's a couple of people have held it. But even look at the, Walmart. You don't even have to, from the Nifty 50 days. People have just held that. And all the other junk in the Nifty 50. Just those internal compounders just really make a difference. It's just, like you said, it's just nearly impossible to hold because you think you're a bloody genius, selling it and you double your money, that's all. But
well, it's like CSL. CSL has always pretty much on any valuation metric looked overvalued, but it keeps going. I mean, it hasn't done much in the last few years, but it's just gone up from bottom left to top right for about 25 years, and everyone sort of, it's expensive, but you would have done extremely well.
I know. And you think, you just can't understand everything, I think, is what I'm trying to come to, I think, and try not to be so salty about stuff and try to think, I'm not smart enough to understand, 90% of stuff out there. What can I stick to and get a bit of an understanding?
Well, that's it. Yeah, Buffett's. You don't have to swing at every pitch, do you? You don't have to get them all. You just have to get a few good ones and sit on them.
I know, but the counter for that is
easier said than done.
The Fed and the RBA, letting inflation burn your hole in your pocket while you're holding on to cash. And so, you feel like you've got to invest. They're sort of forcing you into riskier end of the curve. And you feel like, swing your bum. What Buffett says, don't do. You've got people from the stand saying swing, and you're like, I don't want to swing, but the RBA is saying, swing. Have a go, you're going to get burned here.
And pretty much everything you swung at did okay, or most things you swung at did okay because, everything's basically gone up. I mean, that's what Grantham called it, the everything bubble.
Yes.
It's not nothing.
Nothing.
It hasn't gone up. Anyway, is there anything else? Oh, yeah, Cathie Wood. Cathie Wood, see, that's another reason why I sort of lean towards the bottoms not in stocks is because Cathie Wood came out and started buying NVIDIA. NVIDIA had their second quarter's earnings was, fell well short of expectations. And, NVIDIA's, I think, down 60.
It got crushed yesterday.
Or more percent. Or Tuesday, And then she started buying it. So I thought, well, if Cathy Newman's buying, it's probably too early. And she's still... I saw 2 articles about her where she had outflows in August, but still for the calendar year 2022, she's had net inflows into her fund, which is down peak to trough 75%. So that's amazing. I mean, you would have thought that if we had real capitulation, people would be vomiting that stuff up, getting out as quick as they can. But, the true believers hang on.
Who's got all this extra spare cash on the sidelines to deploy into ARK?
Can we just dispel? Because this is one of the arguments that's going to come up soon. The cash on the sidelines argument. There is no cash on the sidelines because if you have, if you sell stocks because you're shoring up your cash to buy later, right? So then you have cash on the sidelines, so to speak. Who'd you sell your stocks to? See, at every point in time, a stock has to be held by someone. So there is no cash on the sidelines. The only new cash that comes into the market is via an IPO or a rights issue or something like that. But I mean, you see this in news headlines all the time that, investors have unloaded stocks. They're shoring up cash balances for lower prices. And it's like, yeah, but if they unloaded stocks, who'd they unload them to? Somebody who didn't have those stocks, and now they have the. So there's no net. It's a zero-sum game. There's no cash on the side. Or to the extent that there's cash on the sidelines, it doesn't really change. It just changes hands. Who owns the stocks and who owns the cash.
People are rotating out of bonds into equities, that could be cash coming in, couldn't it? Like, is that what they're doing, or
rotating
I think
out
that
of
might
bonds,
you know.
but you still, if
equities.
but if you're unloading your bonds now, you've got cash, and then you're putting it back into equities. If it's the equal amount of money, there's no cash on the sidelines.
No,
you know what I mean? It's zero. It's zero sum to a certain extent. So this idea that when you see, mutual funds have lightened up and they've got big cash balances, or retail investors' accounts are full of cash, but they sold the stocks to somebody else, so it zeroes out. It's not like the stock goes away once they sell it, or they sold it into nothing. They sold it to somebody else. So somebody else has to hold it. So I love the cash on the sidelines one. Can't wait for that. Just comes out all the time. You have a good laugh. Yeah.
The margin requirement thing is the other one that they love putting out as well. Like, people have got so much money that they could get more margin now. They could go into, it's like, I don't know, like you put that thing up before, how much spare cash they got, to actually get into some extra margin, what are they putting up as collateral? And you see a couple of down days and people, get liquidated. I don't know, but it just doesn't seem to be that much margin you can actually take advantage of, really.
No. Well, she's 75. When was that? That was a May article, so that's a bit old. But that was a September 2. Doubles down on Nvidia. Suffers 3 months of outflows. And I think I had one.
What's her bull case on Nvidia?
On old.
Why does she like Nvidia so much?
I don't know, because I can't read that article, because I have to sign up to CNBC, which I don't want to do, because you don't want too much CNBC in your life. That's a no-no. This might be it. Suffers outflow. ARC Innovation has dropped 56% so far. That's the calendar year, but down 74% from February 2021 peak.
Wow.
Yeah. So even her 5-year annualized return, which used to look great, is 6%, which is half the S&P. So she's just another one of these fund managers that underperforms the index, and adds no value, unless of course you got in and out at the right time.
Yeah. So everybody holding those stocks, the forced seller of them, and then drags everyone else down. So even if you think, I'm going to hold in for long term here, you got Cathie Wood selling against you. So, selling your bags, right on the way up, you feel good.
It's a strange thing that, I don't know how I thought that was, you couldn't do that. I thought the SEC would be all over you if you did that, You're promoting this product and then you're selling it, selling, some of the components of it. Net inflow of $2 billion in the 6 months through August 5th. So she had, even this, in the first half of the year, which was horrible for big tech, she had $2 billion worth of inflow into the ETF, and then she suffered an outflow of $835 million in August. I don't know how she's doing now, but it's just get, if I don't know, that doesn't sound like capitulation to me. And again, maybe we don't need to have capitulation. People say, we haven't had capitulation. Maybe you don't need to have capitulation. I don't know.
So out of inflation, we're got 7 handle in the US. So how much of that do you reckon is supply side? An 8 handle. Yeah, okay. So
it's an 8.
So what do you think? How much of that is supply hand, and how much is that from monetary policy? Do you reckon? So how much is, because the supply side should come down a little bit. Should work itself out over the next couple of months. Hopefully, we've been saying that for a couple of months already. But what do you think? What do you think?
I look. Full disclosure: I have not looked at the full contents of that CPI report, so I'm not. I can say a couple of things though. Is that one, markets have consistently underestimated the stickiness of inflation, haven't they? Remember transitory? Well, that has completely gone from the vocabulary, as it should have, because 2 years worth of inflation almost is not exactly transitory. And the other thing, I listened to a podcast 2 weeks ago, Meb Faber. We'll put that in the show notes. I think that's what the pros say, don't they? We'll put a link to that in the show notes. Meb Faber's podcast, and he had Rob Arnott from Research Affiliates. Rob Arnott's a quant guy. I think he invests in sort of smart beta stuff. And he made the observation that the portion of US CPI that covers increases in rent, and it's called owner's equivalent rent, is a lagging indicator, and it lags by about a year. And so he was making the case, 2-3 weeks ago, that CPI was going to remain stubbornly high because you're only just now getting those increases in rents through the CPI. Because if you look at like petrol and things, they were down.
Yep.
Again, I haven't looked at the full components. I've just read some commentary. But gas prices, as they say in the US, were down, but rents were up, and that rent portion is going to continue to be to hold that inflation number up. Now, one way to look at that, if you're the markets, is to say, well, that's old news because this is just a lagging piece of the puzzle.
Yep.
And in reality, the US has already had that increase. I think the US, broadly speaking, across the country, has had a 22% increase in rents in the last year. And that's only just starting to be reflected now in the CPI. So there could be, I think, people have a tendency to think in a linear fashion, like that, okay, inflation peaked at 9.1 and then they got an 8.5 print, and then we're just going to go 8, 7.5, 7, and we'd be at 5.5 by Christmas and 2.5 by the middle of next year. And it's just not going to work that way, I don't think.
It's a trend, just follow the trend. Yeah.
Yeah.
The trend's down now,
what
so
you had,
continue. Yeah.
And the core was double what the economists thought, which who cares what the economists thought, because the economists are wrong. But markets react on hair triggers to what the Fed, the RBA, and economists, what the consensus thinks. For some unknown reason, they still haven't worked out that none of these people have a crystal ball and know what they're doing. But that's the way markets reacted. They overreacted, I would say, but that's what markets do.
Yeah.
I should get that off. I was going to talk about, I think actually you brought this up, and I just found an article on it. You brought this up to me about a week ago about Burry. That what's he saying? He's
sold everything basically, except for sold everything.
Oh, has he?
Private prisons. That's the thing he's keeping. The cash flow looks good on them, but I don't know who's going to hold private prisons. Bit of a wild, but Burry, he's like very short-term orientated, and everyone just looks at his 13F, and then next week, that's out of date. He'll be back into other things.
Changed.
So,
so
but people just look at him and go, "Oh, he sells everything. We should be following him, into the market." Wow, because he predicted, But every couple of months he's loses his mind. But he'll be right somewhere along the line here. Just not sure when. Timing's
anyone's guess.
Do you like the Schiller PE index? Do you, I'll look at that.
Yeah,
it's pretty high. It's near 30, the Schiller PE. So, it's not like 45 or anything.
It is a good earning because it has 10 years trailing smoothed earnings. So that's why it's good. It's useful. But as a timing tool, it's absolutely no use. So you can say the market's overvalued, but it doesn't. You can't time the market based off a Schiller PE. It's just of no use in that. But I do like it as a measure because at least it's consistent over time.
Yeah, and it's not little spikes don't really matter. But the PE now for the S&P 500 is only 19 or something. So that's because these earnings figures are still pretty good. All this money flooding into the system, and everyone keeps their high margins on everything. Because they can just pass everything on. But
those earnings are now getting downgraded. They were, I think they may have started the year. It's like $245 for earnings. They're heading towards $225, and they'll probably go lower. That's usually the way they go. So 225, and you might say, oh, 225, 18 PE, not bad, whatever. PEs can go, I'm not saying it's going to be 1980 and the PE gets to 8, but, there's no reason they can't go lower. And I think the second quarter earnings in the US and the earnings season we just had here in Australia, which was the full year earnings for most Australian companies, were better than expected. And that's probably because you just haven't felt the full effects of inflation. The consumer hasn't really felt it, at least not here in Australia. They're starting to feel it. But and so, discretionary retail's got to be, looking a bit dicey at least. Yeah. But then again, what is discretionary now? If discretionary used to be, like home furnishings and things like that, which I think it still is, but a lot of that stuff gets sold online now. People are locked into sort of, they get a monthly box of stuff sent to them. They just signed up for a subscription. I'm thinking about someone like Adairs.
All that stuff. Can they give up Netflix? What are they going to do with their time at night?
Sit in a corner and cry.
Like,
read a book.
So I don't know. What I was surprised is things you think are discretionary, actually, when things are decreased, people actually keep on to them. Like, you think cosmetics. I thought, oh, wow, that thing would just get smashed. But even in the Depression, like, people go, that's a little bit of luxury I want to keep. But they didn't go out or whatever, so they just kept a few little luxuries like that, and they actually kept things like cosmetics. You think, wow, that'd be the first thing that goes. But, it's just a bit weird.
Yeah, restaurants.
You can't really...
Restaurants. Really.
Yeah, restaurants. And all.
Yeah, what's discretionary changes from... Yeah, because people might think that their Netflix package is, kind of... That's one of the last things they give up, because they're in love with it so much. It's got all their favourite shows or whatever. So who knows? Maybe it's not as discretion as we think. But Netflix has seen their subscriber numbers did go backwards there for a little bit. I don't know how they're holding up now. That'll be interesting. But as usual, I bought
the dip on Netflix. So thanks for that encouragement there, Scott. So.
You did you?
After Ackman decided, let's go and buy it all, and then he, I'm a long-term investor, and then he dumped it a couple of months later, and then I'm going, wow, even his thesis was pretty good. I thought, wow, this is like a really good.
You
thesis.
Didn't buy. Don't tell me you bought it because Ackman bought it.
I bought it when he dumped it.
Is that why you bought?
So that's when I decided, wow, he's dumped and he had a great thesis. I couldn't really knock his thesis. I'm like, I'm not going to buy it now since he's bought it. But when he dumped it, I'm like, wow, he's just getting cold feet here. I'll get in and buy a little bit. And it's held up. I was surprised. I was going, I'm going to have to hold this for a little bit. Like it's going to go 30% down on me here because you saw the sub numbers and, this Disney and all these other people are doing so well compared to Netflix. I thought.
Well, maybe you're onto something there. Maybe there's a core, who knows? Maybe Netflix has bottomed out. I don't know. We brought up in NVIDIA earlier, which I like. I don't own it, but like I said, I think it's down 60%. It was down 90% in the tech wreck, and it was down 80% in the GFC. Now, it's a much larger company now. It's a profitable company. It made $9 billion last year. Some of that was pulled forward, obviously, but they're going to make less than that this year. And so it's down 60-odd%. Yeah, well, is that enough? I don't know. Do I have a margin of safety there? Not sure. It's got to be getting close, though.
What's the free cash flow yield on it? Like, it must be still free cash flowing. That sort of money, you think. Yeah. And that's what I compare it against nowadays. I'm like, what am I going to get in the bond? 3% or whatever, So, look at the 2 year and you're thinking,
I think you can go out.
It's trash.
Well, you can go out and get, solid corporates, you could get 5.5%. I listened to a podcast with a bond manager. You can go out and get good corporate yields at 5.5%. So, that starts to look more attractive. I actually looked up just before we got on here at what you can get with fixed term deposits in cash now, and ING's offering 3.3%, but you have to lock it up for 2 years. So that's 2% below inflation. So you can lose 2% and lock your money up for 2 years. How's that sound? Not great, but Well, I think what's interesting about that is I have not looked at what a fixed interest account actually gives you for 10 years, because there was no point, right? But now, I think people will actually start looking at that. Oh, okay, I can get 3.5, 4, because that's only going to go up, isn't it, in the next few months? Yeah.
But will they increase it above inflation? What do you think they're going to? The RBA and the Fed are going to actually do something decent here. They're going to get some balls and put it up to a decent level.
No, I don't think
neutral rate. Neutral rate they keep talking about. What do you think that is? They've got to get a 4 handle at least. 4.5.
Oh yeah. Well, I think in the US, 4.5 is a foregone conclusion. Here, I'm not so sure because, will they blink? I think the RBA could blink pretty soon, especially because you've kind of got a canary in the coal mine. What's happening in New Zealand? They started raising earlier. They've gone further. Their house prices are crashing harder. So, I don't know if the RBA, who knows? I don't try and guess what they're going to do. I think we can safely say that they're going to break through 3 on the cash rate in the next few months. Yep. But other than that, I wouldn't. Yeah. If they did a U-turn at Christmas, I wouldn't be surprised. Yes, that's a good way of saying we have no fucking idea.
Yeah, we can use catchphrases as well, to make us. Yep. Okay. Well, yeah, I think that's good. Yeah. Good for a chat.
Yeah.
You got nothing else you want to add?
Or... not at this stage. No, I think we're good.
Yep.
That's it for the salty investors.
Okay.
Thanks for listening in.
Okay.